deposit is not going to be a generic product, it has to be a bundle product now. So if I expect that a customer would open a pure saving account at this point of time, possibly I need to bundle out to offer any other product along with the savings so as to mobilize more deposit. At the same time, the preference of all these depositories is also not to have more of a branch banking rather more of a online digital banking. And if you look into these two scenarios, I think the deposit mobilization, which is a constant at this point of time, would improve. We are seeing traction. I'll just give you a small example. It has been innovated on the deposit side. Like a bank like us, like SIP has been a big, what you can say, a flagship scheme for mutual fund. We had a recurring deposit scheme earlier, but never marketed in a way. So within the recurring deposit, we renamed the product as a systematic deposit plan, SDP. So a SIP gives you an uncertain higher return, but at the same time, SDP gives you a certain modest return. So we need to innovate a lot. Things are happening, but at the same time, I strongly believe that current deposit advanced growth is more of a transient, not a structural one. With the liquidity improving the system, possibly things would come back and the banks would move around.
And just picking up on the point that you made on innovation, you talked about SIP. So Mr. Rao, a question to you. The mutual funds here campaign has been quite successful. And he has been in the forefront of doing it. Do you think IBA, being IBA, the banks need to come together to really market deposits a lot more to customers?
Resiliency in your systems, resilience in your technology platforms would be one. The link thing, I think cyber was brought out there. I think all of us are exposed to it. I was told my bank globally gets about 100,000 cyber attacks every day. Okay, so just imagine how much money we are pumping into that part. So I think technology resiliency. I think the other thing would be people. My guess is banking as a source of attractive employment is changing. The narrative is changing, and how do we make sure that they feel good about the role that we as an industry play? And third would be regulatory compliance. I think this, the governor alluded to it in his own remarks. So these three are.
Thank you, Mr. David. Maybe I'll do another round of quick questions, and I'll leave some time for audience also to ask questions.
Cumulatively, it would be about $8.5 trillion. So massive sums of money are going. And in that, about 61% would be green, and the rest would be like social and transition finance, etc. We look at India actually. Dollar bond and other loans that we've seen, about $15 billion was done last year. This year to date it's $16 billion, but it's still 1% of what's done globally. Having said that, I think we've seen quite a bit of the regulator itself, SEBI and RBI taking a lot of steps, and we're seeing, for example, SEBI telling the top 1,000 companies to disclose, and we're seeing good amount of traction, especially in transition finance. If we look at what other regulators have done to enable, if we look at Bank of Japan, for example, for 1 whole year they give the interest-free, the subsidy for the interest portion of the first year. If you look at Mass HKMA, for example, they subsidize the entire second party report, etc. So each regulator is doing something to sort of enable. If you look at PRA, the UK regulator, they, for certain public good, they actually give 25% risk-weighted assets as concessions. So instead of 100%, it will be 75%. So there are various things that we are seeing at play to encourage green finance. Our own bank, we have said that next year we will be in our own operations net zero, and by 2050 even our clients that we lend should be net zero. That's the roadmap.
Public sector banks have also started moving out to get more of deposits. We have kind of got into more of relationship banking, and the main problem for us happens to be in the current scenario, the cost of funds, because of which we are forced to actually move out. If you kind of look at what the previous speaker has just said, the money is within the banks, but it's again the cost of funds, which really matters for us. So what we have traditionally done is we are getting into more and more of relationship banking, moving out, trying to garner more deposits, and probably getting into markets which were earlier uncharted. Probably, if you see most of the public sector banks, at least for Bank of Baroda, we have a huge rural and semi-urban network, which was traditionally a walk-in kind of area for us. But now we are going more and more out into those pockets so that we are able to kind of get businesses, and also trying to compete with the other people, because the funds which are available in the market, especially the low-cost funds, everybody is after those funds. And for us, we have realized that if we do not go out, it will be difficult. So we have also started getting into kind of more and more product innovations which are there, and also move into the markets and give specialized services, in the sense through our relationship managers, and also going for funds which are available everywhere, trying to get in huge amount of funds which are available in uncharted markets, probably the blue oceans, if you may call that. And this is what we've been trying to do by getting in the funds.
So, maybe tougher or the toughest question for you in the end. But you know, cost of deposit is going up. There is more public sector outreach happening. OPEX is going up. As a bank which is more specific, small, how do you then make economics work going forward?
Neha, this is a complex subject we are discussing, and in spite of everybody speaking, there is no solution to this. Okay? So let me just try and address the bigger issue, and then specifically talk about you. What Nilesh said is very right, but the fallacy of the whole thing is that firstly the household savings has gone down by almost 10% in the last decade or so, last 11 years.
In the sense that what is your senior management team, including the CEO and the sort of the board members, talking down to the entire team? The fact is that is the organization's sole objective is revenue growth and only top line growth, or is the organization's objective is balanced growth which takes risk into account? So in a way, is the top management saying that risk is our middle name? Basically, what this first thing is tone at the top. The second thing is that sort of propagating a sort of sensitization of it. And obviously risk, we have credit risk, reputation risk, ops risk. Yeah, ops risk. Then we have climate risk, as you asked. Now one of the issues that we have is that at many times the risk, especially the credit risk and the general the risk teams, are sometimes a little detached from the rest of the organization. At times, I would not like the word, use the word secretive, but they are a little detached. One of the ways of doing this is to mainstream this organization, right? And mainstream the risk and compliance organizations. And one of the ways of doing it is that when you are doing risk, credit risk, cybersecurity risk, ops risk, climate risk projects, induct people from business into those projects. Make it as much cross-functional as possible, so that there is a cross-pollination of risk, that sort of the risk culture or the risk sensitization that happens across the system. Third thing, you only understand risk when your skin gets burnt. That is the real way when real managers understand risk, when you actually go through a situation yourself. Now, one of the ways is that, but it is difficult to sort of, especially for younger managers, it is difficult for them to get the full grasp of risk, right? And many of them are top-line driven, many of them are, especially managers in distribution.
Man hours you are saving, you can use this as a HR for other purposes. Other purposes like maybe it can be marketing, it can be collection, or it can be sale of third-party products, or it can be any other thing other than the mundane task of renewal only, where bank is not earning because the account is already there. So these HR and IT go hand in hand. The more any organization gets into technology in HR, the more productive it will be for the employees. So there is one more data, interestingly, when you go around and read some of the HR researches and journals, that if the employee engagement is correct, the productivity improves, and if the employment engagement is not proper, in the organization, any organization, the productivity gets reduced to as low as 10 to 12% in the of the employee. So that is the data which is prevalent in many of the researches globally. So employee engagement, productivity, and finally the motivation of the employee through technology. Today is the way to go.
Thank you so much, sir.
Recent study, what came out is that globally, close to $800 billion of assets are getting affected on an annual basis. This is based on a very traditional risk modeling approach, CAT modeling, to which you look at hazards and then you also overlay some of the infrastructure, global infrastructure assets, and look at the probability of it getting damaged given a particular event intensity and frequency. That said, in India, that number is close to $30 billion. And $30 billion of critical infrastructure.
In mutual funds, equity, currency in hand, and many things actually. So the proportion of equity and mutual fund in these savings is only 2.3 lakh crore. I think we are making too much out of it.
Absolutely.
So I think because 11 lakh crores is still flowing to the banking system, 12 is still flowing to the insurance and which is available for long term. Only short this thing, because this is again like from Sharmaji's data, it is urban sector. And if you look at the deposit composition also, institutions, trust, government still carry a large chunk of deposit in public sector which comes under the urban category. And that is where some movements have happened. Because government has changed the system and all that, because now those money which used to flow to the banking system of the government is not coming. So this is something. So need not worry too much, because like as the post-COVID there are certain behavioral pattern changes. Now again I think it will stabilize and I think banking will get its share. Working closely with most of these funds and private equity.